Hello, and welcome back to my channel. So in the last sessions, we looked at a brief introduction to venture capital and the structuring of venture capital funds. In today's session, I would like to focus on the entrepreneurial side. And let's just quickly explore how entrepreneurs fund their ventures. What opportunities do they have to raise money? And to do so, let's take a hypothetical startup that goes from idea stage over here all the way to the entrepreneur sitting in the boardroom and basically having gone IPO. So usually founders will launch companies together with co-founders, raise initially some funding with some family and friends, and then basically go into the first potential institutional round, the first proper external money coming in, a seed round. From there onwards, we will name the rounds of funding that are being invested in letters, Series A, B, C, and D. Now, why is funding being raised? Well, those startups usually are not cash flow positive. That means they are pre-profit for sure, pre-revenue, and at times even pre-product, before any product is being created. What happens then, as we start raising external funding, you can see the pie that was initially 100% allocated to the founder is starting to be split up in various slices. And what we're looking at here is basically the equity pie, the equity ownership of that fledgling company, of that startup. So as soon as family and friends come in, basically an option pool may be created for new hires in the company. Founder one, founder two, basically their stake, as you can see, will shrink over time. Now, obviously the idea is that you are running a company ultimately where you own a smaller percentage of a significantly larger company. The idea of entrepreneurial financing is that you won't be able to fund all this growth in the beginning, at least, out of your own pocket. We can have a conversation later on about that. There is an argument to be made that external funding may be not the best avenue to take, depending what kind of startup you have. So now let's have a look at the different funding options that are available to entrepreneurs. So number one, there's bootstrapping. That means you self-fund your business. No external money is being raised. No equity is being handed over. You remain in control of your business, of your company. Now, there are plenty of businesses that will be very successful and will never raise external funding, or will raise external funding only significantly later in the process. Those businesses are then bootstrapped, meaning it's not necessary that the entrepreneur brings all the funding to the table, but they may very quickly become cash flow positive. And then whatever profit is being generated is being reinvested into the company. That's one avenue. Then there are, in certain countries, certain jurisdictions, crowdfunding is still a very much viable avenue. It immediately creates a kind of a fan club around the young company. It may actually even help with marketing efforts. Then obviously there are angel investors, and angel investors can offer a significant support for entrepreneurs. A good angel is really worth his or her weight in gold. They will usually be very engaged in the companies. They will be quite happy to roll up their sleeves, spend time with the founders, and mentor them along the process. Now, there are accelerators and incubators, think Y Combinators of this world, that will allow, especially first-time entrepreneurs, to find immediately a community where they will find advice, they will find like-minded entrepreneurs, they will get support, be it legal support, be it financial support, and they may also get advice on how to potentially raise future rounds of funding. Some accelerators will invest in startups, others may not. Some will take equity, others will not. So we will have another session on those specific accelerators and incubators later on. And then finally comes venture capital. So clearly active investors, very much involved, especially at the early stage with their portfolio companies. Corporate venture capital is not to be ignored nowadays. In the last decade, in the last 5 years especially, we have seen corporate venture capitalists. Those are venture teams, venture investors that have one investor, and that's the corporate parent, play a larger and larger role globally. So obviously the advantage for the entrepreneur is that not only will they be given access to some funding, they may also have access to the experts that come from the parent company, or may be given an opportunity to work together with some of the departments, some of the teams in the parent company. So that can be clearly an opportunity. Now, in some jurisdictions, you will be able to, as a young company, have access to either bank loans or venture debt. Again, this is very much dependent where in the world you are, what kind of company you have, and usually is only accessible once the company has some kind of cash flow. Now, let's talk about the concept of staged financing. As I mentioned before, companies, startups tend to raise funding in regular intervals, usually every 18 months. That means you will try to raise sufficient funding that will get you to your next milestone in 18 months. Let me just start off with a well-known example. So here is Snap. So they basically raised their first seed round in May 2012. Down here you see basically who those investors are, and how many they had until IPO in March 2017. For Snap, by today's standards, Snap had a very, very quick path from initial funding to IPO. 6 years to IPO, a total of $2.6 billion was raised prior to IPO to basically lead them up to it. You can also basically see that clearly significantly more money is being raised in every subsequent round, and clearly different investors come in at different rounds. Not every venture capital fund invests at any stage of the company. They have very clearly their verticals where they are interested to come in and invest in. Now, what value and what else does the VC bring to the table? VCs clearly add value that goes beyond capital, and entrepreneurs are encouraged to do their due diligence and find the venture capitalist that brings the most to the table beyond funding. And what do I mean by that? I'm talking about, let's start off with expertise. VCs usually are themselves experienced entrepreneurs. They have industry knowledge. They can help with future financing rounds because they are well known in the ecosystem. They can open doors for you. They can open doors to potential clients once the product is being built, and they can help the entrepreneurs also with recruitment. Mentorship. VCs usually are very, very closely involved with their startups and are often repeat entrepreneurs. So they've been on the other side of the table, if you like. So they know what it's like to be an entrepreneur, and their experience, obviously, especially during times of stress, is not to be underestimated. And obviously, their network is incredible. But be it for recruitment, be it for opening of doors for future funding rounds, or be it to open doors to some of their other portfolio companies. So clearly the value add for the entrepreneur is not to be underestimated. Nevertheless, the entrepreneur needs to consciously find the best possible match for their stage and for their need at the point of fundraising. Now, as always in life, there's no such thing as a free lunch. There are implications when an entrepreneur takes external funding, VC funding. So as funding is being raised, equity is being handed over to new investors as they come in. And that obviously leads to a dilution of the holdings of the founders. So let's start off here on the side. We have basically various rounds from seed round to Series C. You can see the valuations at which the funds are being raised. Valuations increase as the portfolio company, as the startup develops, and as the startup basically starts raising future rounds. More funding is being raised from one round to the other. Larger equity stakes are potentially being given up to new investors coming in. Ultimately, that means over time that the equity stake for the entrepreneur will drop. So entrepreneurs will go from 100% prior to taking external funding, in our case here, down to 62% of equity stake in the company. Nevertheless, the important part is, in good times, the few subsequent rounds of funding are being raised at subsequently higher valuations, meaning your per percent of equity stake you are giving up, per percent of equity stake that you're giving up, you're receiving more US dollars, meaning your company is worth more. Giving up a percent of equity will bring more funding in. And that's the idea of entrepreneurial funding. You want to start off, you want to raise as little funding as possible in your first round, get to the next milestone, raise your next $3 million of funding, ultimately at a higher valuation, thereby give up less equity per US dollar. Now, there are more implications when taking venture funding. So as we spoke about in earlier discussions, venture capital funds are closed-end funds, meaning they will at one point want to exit their portfolio companies. So one example. So therefore, venture capital funds may, for example, add what we call a drag-along provision, which gives the VC a right to, upon exit, to potentially force the hand of the entrepreneur, i.e. to ask the entrepreneur to sell out together with the venture capitalists. So keeping a close eye on your term sheet, understanding your term sheet is crucially important. Term sheets matter. They can significantly impact the entrepreneur's control in future. So if and when you are about to negotiate your first ever term sheet, the best advice I can give you is get help, meaning reach out, find someone who can help you read through a term sheet, help you understand it, help you basically understand the consequences of the various clauses. And that help can come from an experienced entrepreneur, or from a lawyer with venture experience, or from a friendly VC, meaning not a VC that you're raising funding from, but someone who is in the same space, but will clearly not invest in your company, but is inclined to help you understand the term sheet. It's also very important to ensure that this advice is being given within the geographic space that you are in. So please don't ask for advice from VCs or friends based in the US if you're fundraising in Asia or in Europe. The industry standards can be quite different, and you would want someone who has reasonably recently looked over a term sheet and has an idea of what is being done basically in your respective geography. But this is important. Get your term sheets right. Make sure that you are aware what you're signing. Now, in future sessions, we will continue to look at the entrepreneur's perspective. We will dive deeper into VC's perspective, and obviously we'll have a look at valuations and structuring of venture capital deals as well. What have you done in this session? We looked at the staged funding of startups. We took a closer look at the various sources that are available for entrepreneurs. We also discussed the trade-offs when taking external funding. And we learned that term sheets matter. that you should ensure to understand what you're signing when you're signing, which I guess is a good advice for life. If you like this session, please click like below and follow my channel for future publications. Thank you very much.